Corporate Finance Presentation. Cost of Capital, Debt, Equity, Financing Overview. Get ready, it's time to take your chance with Corporate Finance. Cost of Capital, Debt, Equity, Financing. So we're thinking about ways to finance the operation of the organization so that we can hopefully generate a profit. The general scenario looking something like this: investments are made. We want to basically make investments so that we can get a return on the investments. When you're thinking of investments, you might be thinking about long-term type of project investments. You might be thinking about investing in fixed assets that will hopefully help us to generate a return. The goal of the investments, of course, is for the future return. So the idea typically for most businesses is that we need some money, the funding, in order to invest so that we can then get a return, hopefully that return being better than the cost of the financing in order to invest. Note, as you're thinking about these concepts, you might be in a type of business or think of some type of industries where there aren't a lot of costs to basically start up. And that might be the case, but typically in those types of areas, there's also more competition involved. Oftentimes, there's going to be investments that need to be made in some way, shape, or form, money that needs to be invested for projects, for the capital, and then obviously how we're going to get the funds in order to invest and then get the return on them. So then the funds are going to be needed for the investments. So now we need the funds for the investments. The financing options include debt financing and equity financing. So now we're thinking, okay, well, how are we going to get the funds? There's two kind of ways, broad categories that we can do. We could take debt financing, at which time we borrow the money in some way, shape, or form. We're going to owe back that money plus interest on it. We're basically renting the money. The interest we can think of as the rent on the money, and we're going to have to pay back the principal as well, just like if we had an apartment or something like that, or an office space, we have to pay for the office space, and then we have to give back the office space at the end, same kind of concept. But when we have this type of financing, the interest also often deductible for taxes, so we have a tax impact. On the equity side of things, we could think about, well, why don't we basically issue stock if we're a corporation, providing an equity interest in the corporation, given a piece of, in essence, kind of the value of the corporation, retained earnings, and the future growth potential in the organization as well. Also, as you do that, however, then if you're giving retained earnings, you're also having the voting rights and so on being involved with that type of financing option. So that's what those are your options to get the funds that are going to be needed. So that's the basic scenario then, of course, we have when we're thinking about the financing options. We got investments that we need to make for some future type of return. We need the funds in order to have the investments. And then our options are going to be the debt financing and equity financing. Then, of course, our questions are, well, what kind of financing is available to us? What kind of rates are available to us for the cost of that financing? And what would be our optimal mix of financing options so that we can basically choose the best option for the financing? So earnings generally need to be greater than the fund acquisition costs, the costs of financing. So obviously when we're thinking about taking on some kind of cost of financing, either by taking on some type of debt or by some equity financing in order to invest in some way in equipment, plants, or whatnot, then of course our goal is to say, well, is our expected return, we only want to do this if our expected return is greater than the cost of financing in general. So the cost of capital decision-making process. So now we're thinking about the cost of the capital, what's going to be the decision-making process in order to decide what projects we might do or what type of financing options we might have. The decision to invest in something should not be based on specific financing options. And this is when it gets a little bit confusing, because when we think about certain type of investments, we think about the financing that's going to be connected to that particular investment. But we also want to think about it basically in the context of our capital structure, our financing structure basically as a whole. In general, what we would like to have is some type of rate. Basically, it's going to be our minimum rate or our required rate of return that we can apply to the projects that would be independent to some degree of the financing options, so that we can then think about it in terms of this minimum rate of return, so that we can then be comparing different projects possibly that have similar or possibly different financing options and make decisions in that way. If we were to do so, if we were to make our decisions specific to the financing options, we could have inconsistent investment decisions. So if we narrow our focus to a particular financing option instead of taking a broader view, we might make less than optimal decisions. Financing decisions should be made with an understanding of the company's capital structure. So that's going to be the general rule, the general idea that you want to basically have in your mind. We have the financing that we're going to be taking in place so that we can make our investments. We have the breakout between the options, typically of debt financing, equity financing, and we would like to make our decisions in some format with taking into consideration the weighting of the capital structure. And we'll talk more about how to do that in future presentations.